Ireland's sovereign debt crisis, that could cover a lot of things. I guess it's an all-encompassing title for talking about where I think we are. This is the big picture of Ireland's fiscal problems as they open up and are supposed to be closed. Black line is expenditure, the green line is expenditure minus debt interest, and the blue line is revenue. Now, many people I think will tell you, don't look at this number here, because that includes a very, very large amount of money that was put into Anglo-Irish Bank and Irish Nationwide Building Society last year. But I would say do look at it, because it's real. So what we can see is we were running fairly small surpluses for a long time, with revenue ahead of expenditure. And then this big hole opens up. And how are we supposed to close it? Well, expenditure overall is going to be about steady. And that, if you think you're getting ready for years of cuts, you are getting ready for years of cuts. But one of the dynamics that's occurring, which should be reminiscent of people who were around in the 1980s, is that the debt interest burden is increasing very considerably over the next few years. So a roughly flat expenditure profile is consistent with, pretty significant declines in non-interest spending. Revenue is going to catch up. That's a pretty slow pattern of growth that doesn't actually involve an increase in the revenue share of GDP. So in a sense, this is a sort of growth-reliant kind of forecast. But at the end of the day, we're going to end up with the blue line not too far below the black line, so we'll have a 3% deficit. Perhaps more importantly for debt dynamics, non-interest spending will be below revenue, so we'll be running a primary surplus. And that's what's going to happen in a few years' time. These projections are all based on the European Commission's February document. The Commission has updated its near-term forecasts a little bit since, not a huge amount. But they haven't released any new projections going beyond that. That's not their standard. So this is from their program document from February. The Irish government's program that was released, that was sent to Brussels a week or two ago, is not very different. The difference is on focusing on. So we're going to gradually back off this world record deficit of 32% of GDP, and we're going to gradually return to 3% in 2015. And what's that going to mean? Yeah, one point I want to make about this, because I think there's a certain amount of confusion out there, I think, among European partners and even among parts of the domestic debate about, well, the fact that we have a very large deficit must mean in some way that we are very profligate, that various vested interests have prevented there being, sufficiently large fiscal adjustment. And there's a lot of people who would just say, well, let's just do it, right? Let's spend less and tax more and get it over with. I think it truly is worth recognizing that despite the large deficit that we have, the incremental effort in terms of fiscal adjustment that's been made has been exceptionally large. So that without those adjustments, we would undoubtedly have a far higher debt, and we would certainly be a lot closer to, if not over the edge of, a debt default. Here's a picture from the IMF. The only aspect of the picture I would focus on here is that the IMF surveyed 30 different leading countries in the industrial countries, advanced economies, from 1980 onwards, and looked at the size of fiscal adjustments that were undertaken. And the study ends in 2009, but Ireland 2009 was the largest adjustment that they could find from their 30 countries. And roughly speaking, this kind of measure, so discretionary fiscal adjustment, you would find a similar figure for 2010. I think the figure for 2011 may be bigger. So, let's at least spot ourselves some credit that the levels of fiscal adjustment so far have been exceptionally big. They're basically world record-breaking levels of fiscal adjustment. Despite all that, this is what we're looking at. I've heard many people say that the levels of the debt-GDP ratio that we're heading for, well, this has happened before, and we've come back from debt-GDP ratios of 130% and so on. As far as I can see, looking at the data, that's not true. And I think that there's maybe a lot of confusion here about GDP and GNP ratios. But both the debt to GDP and, if you're of that inclination, the debt to GNP ratios that we're projecting are projected to top out at higher levels. And for debt GNP ratios, significantly higher levels than we saw back in the late 1980s. This is the way the composition of the deficit is supposed to ease off. What we see is, back in the 1990s, we're running quite large primary surpluses. And we are going to edge back towards these primary surpluses, but the interest burden is going to go up to about 6% of GDP. Now, there's an assumption there that doesn't get discussed too much, which is if the debt stabilizes at something like 120%, and the interest is going to take up about 6% of GDP, then implicitly there's an average interest rate on that debt of about 5%. And I think that's one of the risks to the program. But this is the plan anyway. We're going to have a primary surplus of 3%, similar to what we had before the whole crisis began. But we're going to be paying out 6% in interest, and so we'll have a headline deficit of 3%, which is, of course, the magic figure. What's underlying all of that? There's a lot of focus among, like when I speak to international journalists, there's a lot of focus on the political side of it, on adjustment fatigue and austerity fatigue, and the idea that the government may not want to proceed with the plan and the various political risks and how do the people feel and social unrest and all of that. After what we've been through over the past few years, my inclination is to say that that's probably a smaller risk than the other parts of the program. I think we've elected a government that has agreed to stick to the EU-IMF plan. It has a large majority. We're not going to be relying on the deputies from Tipperary South and Kerry to pass. Tipperary North. Sorry, apologies to the people of Tipperary South who vote for much better people. I have a feeling that that's not the biggest risk. But on the other hand, the program comes with all these assumptions, and if we don't, there's a lot of there are sensitivities to all of these assumptions. If growth is faster than is assumed, then the deficits will be lower. If the interest rates are higher, the deficits will be higher, and so on. So let's take a quick look at it. I think the program is quite realistic that we're not going to see rapid growth in the Irish economy in the next couple of years. 0.9% growth is what was in the February program. It's a bit lower from the spring forecasts. But it's not that different from zero. And I think if you look at a wide range of indicators that are reflecting what's happening in the Irish economy right now, I wouldn't quibble too much with that. I think you see an economy that seems to be sort of bouncing along the bottom, despite a lot of challenges, which is maybe a better performance than some out there might have expected. But then at some point, in a way, debt sustainability isn't really so much about the near term. In a way, debt sustainability is about, can you, over the longer term, repay these debts? And where I start to get worried is I see us moving, the plan says we move back gradually in 2014 to 3%, and then we grow at 3% as far as the eye can see. Commission of various long-tailed pictures showing the debt moving down over time. We're also going to get nominal GDP growth of 4.8% because I'm going to guess here that 1.8% is the Commission's interpretation of the ECB's less than 2, but nobody quite knows what the number actually is, sort of interpretation of its price stability mandate. So nominal GDP growth is going to be 5%. Now, if you remember the old adage about growth and debt dynamics and how large a primary surplus you need to run, depending upon the relationship between the nominal GDP growth rate and the nominal interest rate, we turn to this interesting figure, which shows that the average interest rate in Ireland's debt right now is quite low, about 4%. Most of the debt that was issued over the past number of years was issued at low coupon rates when the markets thought that we were a good risk. There's a lot of quibbling about the interest rate on the EU-IMF loans, but that's the smaller part of the funds, and it's still, relatively low, compared to what you would get out there in the market, and probably going to go lower in various ways that I'm happy to talk about. And then we see this 5.4%. So real growth of nominal GDP growth of 4.8 and a nominal interest rate of 5.4% means that if you run the kind of primary surplus that's projected, then you're going to be on a convincing, you're going to be on actually a slow and steady reduction in your debt to GDP ratio. I want to talk about growth, and then I want to talk about the rate at which we can borrow. A few things about patterns of Irish growth in the past. I think it's very important to go back to our historical growth experience and think about what can we repeat and what can we not repeat. You can break down growth in any economy into how many people, how many more people are there this year, how many of them are working, what fraction of them are working, and how productive are those people that are working. Right? Multiply those three numbers together and you'll get GDP. One of the interesting things about the Irish sort of Celtic tiger miracle is a lot of the miracles when you look around the world, you look at Southeast Asia and various countries, are productivity miracles. They're people who used to know how to make things very well, and then they, over a short period of time, have a productivity surge. Ireland is unusual in that the average productivity growth rate over the tiger period was very good. It wasn't exceptionally better than what we had seen in previous periods. You go and look at a chart relating Irish and US labour productivity, what you see is a long period of catch-up. And by the end of the tiger period, we had average productivity levels measured in terms of GDP per worker, equivalent to those in the US. Now, there's a lot of people want to get into measurement issues and GDP and GNP and lots of things like that. But the big picture point is there was a lot of catch-up to do for this economy back in the 1970s. And there were a lot of supply-side things, a lot of things that we could do right to make the economy more productive. We did a lot of them. But there was no good reason in the later years of the tiger to continue expecting productivity growth rates at that pace, nor is there now. This recession has not been about a collapse in productivity. What's unusual about the tiger period was the enormous contribution of employment. Productivity grew and grew decently, but we put enormous amounts of people to work. Here's the fraction of people in the Irish population that were at work in the mid-1980s, about 0.3. And you can see that this is far below what you had in the UK and the US. Right? And there was a combination of factors underlying that, and those factors unwound over time, so that by the end of the period, we had a very similar employment to population ratio to what you saw in the UK and the US. And one obvious one was the unemployment rate. We know that in the 1980s that Ireland had a very high unemployment rate. But actually the bigger contributors were a demographic pattern, which meant that we had lots and lots of really young people, right? Here's the Pope arriving in Ireland. Young people of Ireland are not few, right? And he was right? We were very young. Government politicians of the Celtic Tiger era spent a lot of time talking about our favourable demographics. But the favourable demographics as a contributor to growth in terms of generating more and more people that could go out and work peaked about 1997 or so and has now disappeared. So we've got a smaller and smaller fraction, and Ireland is aging along a different time horizon than other countries, but it's aging in terms of the fraction of people that are out of work. And the other thing was labour force participation. In particular, female labour force participation was very low in the Ireland of the 1980s. And there may be interesting social reasons for that, but at the end of the day, the men couldn't get a job. Right? So maybe that's an explanation for that. But when the economy recovered and was doing well, we saw this huge increase in labour force participation. So that by the end, for a country that doesn't have a lot of the institutions that you see in countries like France or Scandinavia or whatever to support female employment, this was actually a pretty high labour force participation rate. And it's come off a little bit, but by and large, these are factors that won't be repeated. We're not going to have the demographics are going to do what the demographics do. Labour force participation, it's falling off a little bit. We're not going to have this big recovery in it again. So the big story of the Celtic Tiger was this picture. We had 1 million people at work for a long, long time. And then from 1990 to the late noughties, suddenly we had 2 million people at work. And now we've got 1.8 million people. And this bit's been really painful. Okay? And we can hope to reverse this bit. We could hope that the Ireland today is not so different in its labour market structure from what it was in 2007. We could get these people back to work. People who become discouraged can rejoin the labour force. But this is a small fraction of what we saw here before. And there's no particular reason to think that it will come back at the kind of pace that it came back before. So I think the past is going to be a very bad guideline to what the future of the Irish economy looks like in terms of growth potential. And I worry that the 3% growth rate projections, as far as the eye can see, that the Commission are using are based upon, well, this is an economy that used to grow very rapidly, and so we're going to assume that it still grows faster than the European mainland. I'd like to see this thing projected out in terms of what they think is going to happen with Irish labour productivity, how productive they think Ireland is going to be relative to the EU, and I suspect it may not make much sense. I also think the short-term risks are probably all on the downside. I mean, we all see in the newspapers every day what's going on. But we still have a large fiscal contraction to come. There's the problem with the debt overhang for households and firms. The ECB monetary policy cycle is going in the wrong direction for what we would like. And there's still a lot of uncertainty in the economy. Right? The fact that anybody's giving a talk about Ireland's sovereign debt crisis, that creates an uncertainty. And all of those factors will influence how people will look at the Irish economy and investing in the Irish economy in the next few years. So I'm just going to flag that I think the growth outlook is shaded to the downside, both in the near term and in the longer term projections. Interest rates. This is the interest rate that Ireland used to borrow at. It used to be very high, then it was really low. It's going to go up a bit. It's not going to go up much. If you go back and look at this, in fact, my understanding, and there may be people here that know this more about this stuff than I do, I think this big jump here in 2012 to 2013, I think a big part of that is technicality to do with the interest payments on the promissory notes are not counted in these 2 years, but then are counted here. I think if you go through and do a spreadsheet and figure out what the average interest rate on new debt that we're borrowing at in these periods, it has to be pretty low to keep the average rate down to 5.4%. And it probably goes without saying that this is the rate at which sovereign debt markets would be willing to lend to us over long periods right now. Okay? And I do know if you plug that number in for a number of years, the weighted average interest rate does not stay at 5.4%. So it's not as simple as that our debt is unsustainable because the debt ratio is going to be 120% and the market's going to lend to us at 10%, and so 12% of GDP is going to be eaten up by interest. I mean, it's not that simple. We have a lot of existing private debt that matures at various times in the future that has low coupon rates on it. We have the deal from the EU and the IMF, which has much lower coupon rates on it, interest rates on it than this, and which has an average maturity of 7.5 years. Right? So they're not going to turn up one day and look for it all back in one chunk. But it is certainly the case that even if you managed to get people to lend to you at that rate, it would not be sustainable over a longer term. Plus, you have to be careful when you look at market interest rates. What does this mean? This means that there's some guys out there who may be willing to take a punt on Irish debt in the secondary market at 10.5%. Who are those guys? Well, my sense is that they work for hedge funds, distressed debt desks, investment banks. They're not the people that you could rely on to turn up every month in large quantities and purchase primary debt. So, be careful of price signals. Another interpretation of a yield this high is that you just can't do it. You can't fund yourself in large quantities at these rates. So that's a problem for us because we're supposed to return to the market in late 2012. And we can debate what is likely to change between now and then that would allow that to happen. There's a lot of uncertainty still out there revolving what's going on with the banks and what the likely cost to Ireland of the banking situation is. The stress test, PCAR, PLAR exercise was far more detailed, far more useful than previous exercise. It was a highly professional exercise. But anybody can pick up the document and see various uncertainties in terms of how that plan is supposed to play out. The plan has various assumptions about the costs of deleveraging the Irish banks, of selling off assets, using those proceeds to pay back central banks. You know, they may be pessimistic or they may be optimistic, but it's a risk. There's various assumptions about funding. You know, will deposits in the bank stabilise? There's evidence that perhaps they have in the period since the March 31st announcement. But you know, we don't know what kind of triggers could set off further rounds of deposit outflows. And there's the various risks associated with the central bank funding and what the potential cost of central bank funding may be. You know, the ECB invents some new facility that has a higher interest rate than it currently has. It's never quite clear what's going on with that. And then if you look at the stress scenarios and you think, okay, so they're supposed to keep Tier 1 capital ratios above 10.5%, I think many people out there can imagine stress scenarios that are more stressful than the stress scenario in the PCAR, PLAR exercise. And in fact, even in the baseline, the losses that are projected in the baseline, there's a lot of losses that are supposed to occur beyond the 3-year horizon that the recapitalization figures account for. So even if things go as the baseline goes, if you try to sell those banks in a few years' time, you know, and things are going to baseline, you know, they can produce the BlackRock report and say, well, you know, we're expecting further losses on the books of quite considerable amounts. You can argue that that's not the way that that most banks manage their, you know, their accounting in terms of their capital ratios and all of that. That's fine, right? But most banks that you're thinking about selling don't come with a very expensive consultant's report promising years and years of additional losses on your mortgage book and so on. So I think that has to be a negative. So there are questions about this commitment. I don't think it's so much the solvency of the banks per se, although some might differ. But every time these banks are supposed to get near 10.5%, we're supposed to, you know, put money in. There's questions there about whether or not we can do that. So I see a lot of positives and negatives for debt sustainability. Positives are that, well, the debt is high. Most of the debt was issued at low interest rates. The EU-IMF funding has a long average maturity. Negatives, debt burden looks even worse when you look at GMP. And it certainly wouldn't be sustainable at current market rates. And there's still this sort of asterisk of the banking situation and how it resolves itself. And look, it doesn't really matter how I weigh up these positives and negatives. At the moment, the market puts more emphasis on the negatives than the positives. So that means that most likely Ireland is going to have to look for another deal. The program, when it was released, wasn't very clear about the fact that it intended to have Ireland return to the market, that the plan was to have the Irish government return to the market in late 2012. I can find you a lot of quotes from around then from Misters Cowan and Lenihan telling us that they had secured funding for 3 years, 4 years. So one guy in the Vincent Brown show say 10 years. We shall remain nameless. But the truth was, it was enough money to get us through to about early 2013. And, you know, they didn't want us running out of money one day and then turning around the next day and saying, oh, all the money's gone. So the plan involves having a period where we both borrow from the market and from the EU and the IMF from late 2012. So this plan means that this budget that's coming up is one that puts the Irish government under pressure to be able to return to the market next year. And most likely, it's probably not going to happen. There's always ranges of outcomes, but most likely, I think most people, if they're honest, that know the situation, say that this probably isn't going to happen. So fine, we just get another deal. Well, yeah, but things are getting complicated. one of the complications is we now have to borrow from this European stabilization mechanism and not the existing European funds. And the first thing that happens when you walk in and look for money from the European stabilization mechanism is they set you a test, a sustainability test. And they only give you money if you pass the sustainability test. And this test is pretty much going to be in the eye of the beholder, right? You know, we don't know whether if the passing grade is going to be 40% or 60%, you know. At UCD, undergraduates have to get 40%, but I make my PhD students get a B average. So you can set the line wherever you want. Key point in the sustainability analysis is, long quote here, but if you fail, then the beneficiary member state will be required to engage in active negotiations in good faith with its creditors to secure their direct involvement in restoring debt sustainability. In other words, you need to default on your private debt. Restructure is now the new word, or reprofiling. We've lots of new words, but they involve not meeting the original debt conditions of the original debt contract. Now, how likely is that to happen, that Ireland would fail? There's a lot of strong arguments to say we would pass, because the sustainability analysis is likely to look like the earlier graphs that I had, right? They'll plug in macroeconomic assumptions, and they'll plug in what their interest rate that they lend to people at, and you'll see a lot of charts that look like this and sort of come back down. Provided, of course, that is that we have stuck to the plan and that things don't look a lot worse in late 2012 or early 2013. If we haven't had growth, if deficits have slipped, you know, they may just throw their hat at it at that point. But there are other concerns, and I think one of the other concerns is that if Ireland gets a second deal involving the ESM, private creditors are going to look at Ireland differently. The IMF are a preferred creditor. EFSF is not. However, the ESM will insist on being a preferred creditor, preferred above private creditors. You're also going to see bond redemptions ramp up after 2013. So that even though budget deficits may come down, that doesn't mean that the amount that we'll need to borrow comes down. This is a chart from the EU Commission's February report. And you can see bond redemptions over this couple of years have not been very small. I mean, they date past to the pre-crisis era. But after that, you start to get larger grey bars, which are our sovereign debt, coming from the money that we borrowed in 08, 09. And the red and yellow bars are the money that we got from the IMF and the EU. And you start to see amounts that we need to roll over, in addition to budget deficits, like 12 billion, like 16 billion, like, you don't even want to look at that one, right? These are very large amounts of money. And private creditors may just say, the more money those guys owe to people who say they're better than us, and that don't want to take a haircut, then the more risk there is for us. So existing private creditors are going to face greater risk. Not only that, but new private creditors, people who bought a new Irish government bond, you know, minted 1st of January 2014 or whenever it is, or 1st of August or whenever that is, we believe that that's going to come with, you know, collective action clauses and the like that single these guys out, perhaps making them subordinate even to existing private creditors. So the question is, do you want to buy a bond of a country that has had a fiscal crisis, but has turned it around, has a debt-GDP ratio of 110%, and you could look at it being one recession away from being back to crisis. Plus, they owe tons of money to guys who insist on getting it all back and have basically promised to haircut you if things go wrong. So I think the ESM could be a sort of a black hole, that, you know, once you get close enough to it, you don't get out for a long time. That's probably not a great scenario for us. I suspect it's an even worse scenario for our European partners. I don't think that the German public is going to like the idea of owning most of the Irish public debt and being involved over a long-term period in the Irish situation. So I think a lot depends on Greece. We can see that there's movements. There was a coordinated strategy from various German politicians over the last month or so to sort of use various buzzwords. Now we have Jean-Claude Juncker, a man whom we know doesn't lie, saying that we may have to think about doing some sort of restructuring. If that happens and it doesn't provoke a financial crisis, then one of the big arguments against restructuring the Irish debt disappears, from the European perspective. And should there be a financial crisis? Should there not? Well, it's not Lehman Brothers. It's not gonna. It won't. When it happens, it won't have happened overnight. And there's a lot of people who have had chances to get rid of their positions in Greek sovereign debt or hedge them in various ways. That is not to say there aren't banks out there holding large wads of it at full market value who basically have known for a long time that they're toast if Greece defaults. However, one would hope by now that financial regulators and governments around Europe know exactly who those banks are and are there with the ambulance the day it happens to provide recap funds or whatever it is that it takes. So you never know with financial markets. And a Greek restructuring could be the end of the world, right? But it might not. But it looks like something's going to happen. And it's going to happen probably before we go and look for money. I think in particular, what's particularly interesting about Greece is most likely the Europeans are going to do something, but they'll do the bare minimum, right? So they'll take some step, it'll be a small step. So the most likely thing that will happen is a sort of light dusting approach. They'll extend the maturities of the existing bonds and they'll maintain them at, they'll make them pay the existing coupon rates. So you could hold these bonds in the banking book at the same value that you had before. There's no banking crisis, but you lock in a lot of private debt. You don't get this black hole moment of Greece goes over to owing all its money to the official creditors. And you lock in, importantly, the coupon payments on those existing Greek debts are pretty low. So that helps with debt sustainability. That's probably not enough for Greece, but it certainly helps. It would help us quite a bit in the sense I think it would help us lock in for a long period of time that interest rate that we saw there, the 5.4% interest rate. That would help a lot if we could, if that could be done. But of course, that would be a sovereign default. And various questions about would that trigger CDS contracts and all of that. I mean, in a sense, it doesn't matter to some, but the big reputational thing is people will see that we bought an Irish sovereign bond and it didn't do what it said in the tin. Do we want to do that? I think one of the questions about that we should be asking ourselves, and this goes back to Morton Kelly's recent article, is if the Europeans turn up at the door and say, well, we want you to restructure your debt, I think it's a reasonable question to ask as to which of the following options would do Ireland more reputational damage. Option A, restructuring our official sovereign bonds. Or option B, ceasing to pay out on the promissory notes to Anglo and Irish Nationwide Building Society. We have a promise to pay $3.1 billion a year, as far as the eye can see, well, until 2023, and then a bit more 2024, a bit more 2025. What do we get for that? Not a whole lot, right? I mean, it goes into Anglo-Irish Bank, and Anglo-Irish Bank will use it to pay back central banks of various sorts. And I'm sure the public will be thrilled to see that happen after we've had a sovereign default, that we're still doing that. So given that the vast majority of bond investors out there that I've spoken with, that whole Irish sovereign paper, think that the Irish bank guarantee was a terrible mistake, and that Ireland should not have taken on all of Anglo's debts, defaulting on the promissory note, which is the sort of demented love child of Brian Cowen and Sean Fitzpatrick, would seem to a lot of people to be a pretty good move. Downside to that, Anglo would be insolvent again. Right? What's new, right? We say. Well, what's new in this case is, so in the old days we used to have great fun. On the Irish Economy blog and other places, talking about these senior bondholders, right? And what we weren't going to do to them, right? And I think that's really, Pat, what we moved on to from the NAMA days, rather than reversing our position. The problem is most of those guys got out of town. Most of those guys have been paid off. And who do they owe most of their money to now? They owe their money to central banks of various sorts. And it's also been sequenced and constructed in a very particularly sort of clever way. But they owe a lot of money to the ECB, but the ECB at least has collateral. Right? Now it's Anglo collateral, so it's probably very bad collateral, if you had to guess. But it's something, right? Irish Central Bank, on the other hand, in its separate ELA loans, also is owed a lot of money from Anglo. And what's their collateral? Their collateral is the promissory note. great, right? So, Lorcan has drawn great circular charts of how this whole sort of crazy logic as to where the money comes from and who owes who to what. So technically, if we stop paying out in these things, one of the problems that we'd have would be the Irish Central Bank would be insolvent. Now, what's that mean? I don't know what that means. I worked for the Irish Central Bank, and I don't know what the Irish Central Bank being insolvent means. John Bruton had an article last week decrying Morgan Kelly and saying that, if you think of this in terms of the ECB losing lots of money, the ECB would be insolvent, and it would be the end of the euro, and there'd be plagues of locusts and frogs and so on. I mean, the truth is, central bank balance sheets are basically theoretical, right? So a central bank buys an asset, and it prints off a load of electronic money, and that costs it nothing, right? And people can turn that into banknotes, they turn it into a €1,000 banknote, and central bank has on its balance sheet a liability that's worth €1,000. But the €1,000 banknote, very popular with drug dealers, but only costs, 10 cents or whatever to produce, right? We don't make them out in Sandyford. They don't let us do that one. Could be the end of all our problems. So central bank balance sheets are sort of, this is the last slide. So central bank balance sheets are sort of theoretical. Really what it means, there's a convention out there in central banking circles that you shouldn't just sort of helicopter drop money. Right? In this case, basically what would have happened, you would have helicopter dropped the money on Anglo-Irish Bank, and it didn't pay back. Right? The social convention is if you're going to print off money, you use it in a proper market transaction and you purchase an asset, and nobody particularly gets favored. And of course, if you could do this, you could just helicopter drop money on everybody. Right? You could helicopter drop money in the Irish state, on Portugal, on Greece. And so this is not the end of the euro, if this were to happen. But it's certainly a slippery slope towards things that our European colleagues are not keen on. I don't want to push this too much. I just want to point out that from our perspective, we need to think about the money that we owe and what it's doing for us. And if we do reach a point where others want us to restructure, there are a few cards here in terms of what other people want us to do and what we still have within our discretion. That's basically just what I already said. So I'll sit down. Okay? Thank you. Thanks,